Howdy, y'all. Welcome to Birdie Call. Today is Monday, November 20th, 2023. It's a short week, holiday week coming up. Got Thanksgiving, Turkey Day. Hope everybody's excited for that. And it's snowing here in Colorado, well, in my part of the world. I was up in Denver earlier for checkup with my rheumatologist, and it's just raining up there. But down here, got snow, a little white stuff falling all over the place. So, yay! It's not really piling up, so I don't really have to shovel too much. Anyways, hope everyone had a fantastic weekend. The Cougars basketball team won their little tournament in Charleston, which was good. Not so good. The FSU lost their quarterback for I imagine, the rest of the season with a busted leg. I haven't read any articles as far as what, if it's broken or what, but it was sticking out sideways. It was not a pretty thing. So anyways, if it is your first time watching Liberty Call, I'm glad you were here. Thank you very much. If you could do me a favor, yes, you, I'm talking to you right there. If you could hit the subscribe, likes, share, subscribes, all the thumbs ups, all that, and a notification bell because you want to know when I go live, because occasionally I do say something smart. It's not every day, usually once a week. So, all right, let's go ahead and get into today's numbers. Dow Jones was up 0.58%, 203 points. Closed at 35,051. S&P 500 was up 0.77%, closed at 45,48. NASDAQ up 1.13%, closed at 14,284. All of these, the overnight futures were in the red. So I'm not, or at least when I checked them last at like 2 a.m. Let's see. The VIX was down 2.83%. It's at 1341 right now. Canada up 0.35, Brazil up 0.9, and Mexico up 0.41. Over in Europe, Germany was down 0.11%. The UK the same. France was up 0.18. Netherlands up 0.12. Spain up 0.79. Italy up 0.15. Switzerland up 0.03 and Portugal up 0.7. Russian exchanges both green today. The MOEX up 0.03, so pretty much flat. RTSI up 1.82%. And the overnights in Asia, the Nikkei in Japan was down 0.64. Australia up 0.13. New Zealand up 0.23. In China, the Shanghai was up 0.46%. The Shenzhen Component up 0.43. China 50 up third. DJ Shanghai up 0.4. Hang Seng up 1.66. And the Taiwan weighted was flat, up 0.01% for the day. All right. So exciting stuff, I know. All right. Let's go ahead and run over to the weekly economic update. Shrink that down. All right. Stocks extended their November rally last week as investors cheered lower than forecast inflation data. The Dow Industrial Average gained 1.94%. S&P 500 was up 2.24, NASDAQ was up 2.37, and overseas was up 3.36%. Stocks march higher. A better than anticipated consumer inflation number on Tuesday sent bond yields sharply lower, igniting a powerful, exceptionally broad-based rally that saw 91% of all New York Stock Exchange volume advancing in price and a similarly substantial advance of 85% on the NASDAQ. Small cap stock performance was solid, surging 5.2%, more than double the advance of the S&P 500. Further gains came the following day as wholesale price inflation rose even slower than consumer prices. The rally paused in the final days of trading as stocks digested their gains and investors assessed weak retail sales and industrial production reports and a rise in continuing jobless claims. Inflation cools. Two inflation reports released last week, the CPI and the Producer Price Index, showed continued inflation progress. Consumer prices were flat in October from the previous month, while the 12-month increase was only 3.2%. Both were below market forecasts. Core CPI, excluding food and energy, also moderated, rising just 0.2% in October and 4% from a year ago, below forecast. The climb in annual core CPI was the lowest in 2 years. Producer prices confirmed the disinflation picture as wholesale prices declined 0.5% in October versus a 0.1% forecast. It was the biggest decline in 3.5 years. Over the last 12 months, wholesale prices rose just 1.3%. Key data coming out this week. Tuesday, we have existing home sales and the FOMC minutes. Wednesday is durable goods orders, jobless claims, and consumer sentiment. And on Friday, we have the Purchasing Managers Index Composite Flash. Companies reporting earnings this week. On Monday today, we have Agilent Technologies. Tuesday, we have Nvidia, Lowe's, and Analog Devices. And Wednesday, we have John Deere. All right, so that's everything for the weekly update. Exciting stuff, I know. If you're still awake, Let's go ahead and jump over to the market recap for today. U.S. stocks jump as tech shines ahead of Nvidia earnings. Fed minutes this week. So the Fed minutes are helpful, especially if you have trouble falling asleep. All right, U.S. stocks saw an extension of gains, primarily driven by the tech sector as investors anticipated Nvidia's earnings report and awaited the release of minutes from the Federal Reserve September meeting. September, should be October. When was that? Yeah, it was the October meeting. These Fed's meeting minutes scheduled for Tuesday, a day earlier than the usual due to the Thanksgiving holiday, will be closely scrutinized for insights into the central bank's stance on interest rates. Traders have already priced in the likelihood of the Fed maintaining unchanged interest rates in December, with increasing odds of a future cut, possibly by the start of next summer. I know the article we covered last week, they were pinpointing around May for a interest rate reduction. I think a lot of that's going to have to do with what the economy's doing. If the economy's in the shitter, they're probably going to cut rates just because that's what the Fed likes to do. Microsoft stock rose 2.1% following the appointment of Sam Altman to lead a new advanced artificial intelligence research team. Altman, who was recently ousted as CEO of OpenAI, has drawn talent away from his former company to join Microsoft, according to reports. Yeah, there was a lot of scuttlebutt over the weekend about OpenAI trying to bring him back, and then the board all quit, and it was just a big mess. The upcoming earnings report from chipmaker Nvidia, scheduled for Tuesday, is expected to influence sentiment in the big tech sector. Nvidia's guidance will be closely monitored amid concerns about U.S. chip restrictions on shipments to China and heightened competition from hyperscale customers. Boeing experienced a more than 4% rise after Deutsche Bank upgraded its rating on the aircraft maker to buy, citing expected increase in aircraft deliveries that could boost cash flow. Are those civilian aircraft or those military? Because with all the military stuff going around, I imagine that's why Deutsche Bank is high on the defense contractors. Now, if it's just for passenger planes, I don't have a problem with that. All right, where were we? Citigroup stock rose 0.6% following CEO Jane Fraser's announcement of several management changes in a memo to staff. However, Bristol Myers Squibb's stock fell over 4%, impacting the broader healthcare sector as the drug maker faces delays in gaining approval for the expanded use of its blood cancer therapy. Energy stocks saw an increase in oil price as oil prices rose on expectations that major oil producers might discuss deeper output cuts during their meeting later this month. This followed reports that OPEC Plus is considering additional oil supply cuts to support prices. In summary, the market's focus remains on key earnings reports, Fed minutes, and the development in various sectors, including tech, aviation, healthcare, and energy. All right, so not too bad today. Now on to some less happy news. This comes from Zero Hedge. The article is titled "Peter Schiff, a soft landing is impossible." This comes via Schiff Gold, and you can probably listen, or actually you could watch his the long form of this summary here on I think it's on YouTube. I listen to it usually on my podcatcher. So let's go ahead and get into what the summary is of this article. All right. According to the mainstream narrative, the Federal Reserve has successfully tamed inflation and a soft landing awaits the economy. However, Peter Schiff challenges this idea, asserting that a soft landing is impossible. Wall Street anticipates a shift in Fed policy, transitioning from interest rate hikes to cuts in 2024, sparking market enthusiasm. Of course, cheap money is always a good thing. The belief in a soft landing is grounded in the expectation that the Fed will proactively cut rates to prevent a recession and cushion an economic slowdown. Peter Schiff dismisses this optimism as wishful thinking, that's in quotes, predicting a hard landing regardless of the Fed's actions. Drawing on historical precedents, he highlights the challenges the Fed faces in normalizing rates, citing the difficulties in the late 1990s, the 2008 financial crisis, and the abrupt rate hike reversal in 2018. The attempt to move rates from around 1% to over 5% in 2007 led to the Great Recession, emphasizing the consequences of artificial rate manipulation. Schiff questions why anyone believes the Fed can normalize rates without similar repercussions, emphasizing that artificially low rates encourage irrational economic decisions, leading to malinvestments. We can see a lot of that in the economy right now, accumulating in a collapse when the period ends. The current scenario, marked by a prolonged periods of low rates, quantitative easing, and subsequent tightening, suggests a more significant shock to the system than in 2008, indicating a need for a substantial correction and a more extensive recession. Contrary to market optimism, Schiff asserts that a soft landing is unattainable and recession is inevitable, given the magnitude of malinvestments and misallocations resulting from years of manipulated interest rates. I agree with everything he said wholeheartedly. Everything the Fed has done the last 20 years has, really done. I mean, yeah, it made things, seem fine for the better part of the last 2 decades. But, you keep those rates at or near zero for all of that time, it's going to create a lot of, built up inflation in the system, which, is the inflation we're feeling right now, is it from 3 years ago and all the printing we did? Well, not we, it's not me, the government and the Fed did 3 years ago, or is it the built up inflation from, keeping rates at zero from 2009 till 2018, 19? So I don't know. It could be both. So, all right. One last article here comes from our friends over at First Trust, Mr. Brian Westbeer, their chief economist. This week's article is titled Consumer Spending Set for Slower Growth. All right, let's see what he has to say. As the Christmas shopping season approaches, the focus on consumer behavior intensifies. The article emphasizes the significance of production, entrepreneurship, innovation, and cultural institutions for economic growth, challenging the predominant emphasis of consumption. It underscores that government policies, including tax rates, spending, and regulations, along with monetary policy, influence long-term economic factors. The article highlights the extraordinary policy response to COVID involving substantial government checks to consumers, resulting in increased purchasing power. Consumer spending becomes a key metric to gauge the remaining inflationary impulse and the timing of the Federal Reserve's tighter monetary policy. While real consumer spending has grown 2.4% in the year ending in September, the author anticipates a decline in the growth rate for several reasons: the accelerated job growth, eating into excess savings accumulated during COVID, and the resumption of student loan payments are identified as factors contributing to a potential slowdown in consumer spending. The article predicts that the pace of saving, which temporarily slowed during due to government checks, will eventually revert to previous levels, impacting consumer spending growth. Despite the forecasted decline in consumer spending growth, the article argues a recession does not necessarily hinge on a drop in consumer spending. It cites that the 2001 recession, when real consumer spending increased while the unemployment rate rose. Mr. Westbury cautions against premature declarations of victory by economists who dismiss recession concerns, emphasizing the link between the surge and reduction in the money supply and the corresponding inflation patterns. They predict a challenging year ahead for those who underestimate these connections. So again, I've been saying this over and over again: be prepared for the worst. Let's hope for the best. Life is going to fall in between those 2 points. Let's just hope that the worst isn't as terrible as it could be. So, because there certainly could be pretty awful. So, and again, if the government tries to help us, that just leads to more problems down the road. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information. I hope you have a wonderful evening, and I'll talk to you guys next time. Adios.